Hello there. Thank you for joining me for this session on accounting for bonds. In our previous session, we delved into the fundamental concepts of accounting for liabilities. Today, we'll build on that knowledge by specifically discussing a crucial type of liability called bonds. By the end of the session, you'll have a solid grasp of the unique characteristics of bonds, how the bond issuance process works, and the accounting treatment for bonds issued at varying prices. Let's outline the core topics we'll be covering in this bond accounting session. We'll start by defining bonds, exploring their characteristics and understanding the different types available in the market. Then we'll learn how accounting treatments differ depending on whether a bond is issued at par, at a discount, or at a premium. Finally, we'll also address specific scenarios like zero coupon bonds and the early retirement of bond-related debt. My goal for this session is to simplify the complexities of bond accounting and give you the tools to confidently record and report bond transactions accurately. Let's begin by revisiting the key characteristics that distinguish bonds from other financial instruments like stocks. Companies raise long-term capital through both stocks and bonds. However, bonds offer certain advantages that make them appealing under specific circumstances. One such advantage is maintaining control. Bondholders, unlike stockholders, do not gain voting rights or ownership in the company. This allows existing owners to retain decision-making control. The next advantage is tax benefits. A significant benefit of bonds is that the interest paid to bondholders is tax deductible. This reduces the overall cost of borrowing, while dividends paid to stockholders are not tax deductible. Finally, companies can strategically use bonds to amplify their returns. If the expected return on investments exceeds the bond interest rate, borrowing funds can boost profitability for existing shareholders. It's also important to acknowledge the risks associated with bonds. Unlike equity, bonds create fixed obligations, so there's always bankruptcy risk. Interest payments must be made regardless of company performance. Failure to pay leads to bankruptcy. Then there's also cash flow pressure. Bonds require repayment of principal at maturity, putting pressure on the company's cash flow management. Bonds are a valuable financing tool when used strategically. The decision between bonds and equity depends on a company's specific goals, risk tolerance, and financial situation. Now let's break down the key vocabulary you'll encounter when working with bonds. These terms are essential for understanding the mechanics of these securities. First, principal or par value or face value or maturity value. These terms all refer to the same thing: the amount the bond issuer must repay to the bondholder when the bond reaches its maturity date. It's important to be familiar with these synonyms as they will be used interchangeably a lot. Next, stated interest rate or coupon rate. This predetermined rate, stated as a percentage, is used to calculate the periodic interest payments made to bondholders. This rate is set when the bond is issued. Remember, regardless of a bond's selling price, the periodic interest payment is always based on the principal or par value multiplied by the stated interest rate. The world of bonds isn't one size fits all. Bonds come in various forms, each with distinct features designed to cater to the diverse needs and risk appetites of the investors. Just as car buyers seek specific qualities, bond investors have their own preferences. Some prioritize security over high returns, while others may be willing to take on more risk for the potential of greater yield or conversion options. Companies strategically tailor bond characteristics to appeal to different investor segments. Let's look at some of the key bond types here. First, secured bonds. These bonds offer investors added security by pledging specific assets as collateral. A prime example is a mortgage bond where the collateral is the house itself. Next, unsecured bonds, or also known as debentures. These bonds don't offer asset-backed security. Investors primarily rely on the issuer's creditworthiness. Next, callable bonds. These give the issuer the flexibility to retire the bond before maturity, potentially to their advantage if interest rates decline. Then convertible bonds are a favorite with some investors because they offer the option to convert the bond into common stock of the issuing company, providing potential for capital gains. And finally, zero coupon bonds. These bonds are unique. They don't pay periodic interest. Instead, they're sold at a deep discount to their par value. The investor's return comes from the difference between the purchase price and the repayment at maturity. By understanding these bond types, you'll gain a better grasp of how companies creatively structure debt offerings to attract capital and how investors can select bonds that align with their investment goals. Let's examine the core components that come into play when a company decides to raise capital by issuing bonds. The bedrock of this process is the bond indenture. Think of this as the legal blueprint, the rule book governing the relationship between the company and its future bondholders. This contract specifies all the important details: the lifespan of the bond, the interest rate paid to investors, when those payments will happen, and if there are any special features like the ability to convert the bond to stock. Covenants within the indenture provide an extra layer of protection for investors. These are requirements that might somewhat limit the company's future actions, aiming to reduce the risk for bondholders. Naturally, there's always a bit of negotiation here. Companies desire flexibility while investors seek security. To attract these investors, companies create a prospectus. This is a thorough legal document designed as a sales pitch for the bond. It gives potential investors a clear view of the company's background, the specific bonds on offer, and how the money raised will be used. Upon purchase, a bondholder receives a bond certificate, their official proof of ownership. This document highlights all the key terms of the bond. Each certificate for a given bond issue is the same. Further, a trustee acts as a watchdog for the bondholders. This independent party's primary role is to make sure the issuing company lives up to all the promises made in the bond indenture. Finally, understanding risk is key for investors. This is where rating agencies like Moody's and Standard & Poor's come in. They analyze bonds and assign ratings that signal how likely it is that an issuer might not be able to fulfill their obligations. This concept of default risk is something investors pay close attention to. Let's dive into how bond transactions are reported. When a company issues bonds, the bond contract specifies two key types of future cash payments: the principal, which is a single payment made when the bond reaches maturity, and regular cash interest payments, which are computed using the contract interest rate. It's important to note that the company doesn't directly control the selling price of a bond. Instead, the market determines the price using present value concepts. To calculate this, we consider the present value of both the principal and the interest payments. Let's understand the two crucial interest rates that drive bond pricing. Think of this seesaw graphic. On one side, we have the coupon rate. This is the bond's fixed sticker price for interest, which is set when the bond is issued. It dictates the regular cash payments investors receive. On the other side of the seesaw is the market rate. This rate is dynamic, reflecting what investors currently demand based on the bond's risk and overall market conditions. The market rate is essential for determining the bond's actual selling price. Now picture this. If the seesaw is balanced, meaning the market rate equals the coupon rate, the bond sells at par value. If the market rate dips higher than the coupon rate, the bond's price drops, selling at a discount. Conversely, if the market rate dips below the coupon rate, the bond becomes more attractive, selling at a premium. You don't really have to memorize any of this. Here's how you can remember this comparison. If the coupon rate is less attractive than what the market expects, the only way to make the bond competitive is to offer a discount on its price. Conversely, if the bond offers a higher interest rate than the market standard, investors are willing to pay a premium to secure these better returns. Remember, regardless of whether a bond sells at par, premium, or discount, it's ultimately priced to provide the market rate of interest. In our upcoming slides, we'll delve into the specific accounting treatments for bonds issued under each of these scenarios. Okay, now let's first focus on bonds issued at par before tackling discount and premium scenarios. When a bond is issued at par, it means that the bond's selling price equals its face value, in this case $1,000. This occurs when the bond's coupon rate matches the prevailing market interest rate. Let's assume that the coupon rate and the market rate are both 10% in this case. Let's visualize the cash flows for our example bond. The company receives the $1,000 face value upfront from the investors when the bond is issued. The bond has a 10% coupon rate. Since payments are usually semi-annual, investors receive $50 in interest every 6 months for 2 years. This aligns with the market rate for similar bonds. At the bond's maturity, after 2 years, the company repays the $1,000 principal amount to its bondholders, completing the bond contract. Let's confirm that the bond's selling price at par is indeed the present value of its future cash flows. Recall that our bond has a $1,000 face value, a 10% coupon rate paid semi-annually, a market rate of 10%, and matures in 2 years. This table demonstrates the calculation. Remember, since interest is semi-annual, the market rate per period is only 5%, which is half of 10%. We calculate present value factors using this market rate. So for example, 1 over 1 plus 5% to the power of 1 is 0.95. And the rest of the present value factors are calculated by just changing the power to 2, 3, and 4 to denote the number of periods you'll have to wait to receive this cash payment. Each interest payment's present value is determined along with the present value of the principal repayment. So you simply multiply the cash flow with the present value factor in order to get the present values. Summing these values gives us $1,000, which verifies that the bond's price does in fact represent the present value of its future cash flows discounted at the market interest rate. Alternatively, we can also use a PV formula using a spreadsheet application like Microsoft Excel or Google Sheets and calculate the present value or price. Now let's translate these cash flows into journal entries. When the bond is issued at par, the company receives cash equivalent to bond's face value. We record a debit to cash for $1,000. The liability created is represented by a credit to bonds payable for $1,000, reflecting the company's obligation to repay this amount in the future. Each semi-annual interest payment involves recognizing the cost of borrowing. We debit interest expense for $50 and we credit cash for $50, showing the actual outflow of cash. At maturity, the company eliminates the bond liability by debiting bonds payable for $1,000. Simultaneously, the company credits cash for $1,000, representing the principal repayment to bondholders. Now let's explore bonds issued at a discount. This occurs when the market rate is higher than the bond's coupon rate. In our example, the bond has a 10% coupon, but the market rate is considered to be 12% semi-annual. But how do we obtain the price of the bond issued at a discount? Again, we calculate the present value of each cash flow using the market rate, which is 12% now. So 6% per 6-month period should be used as our discount rate. Notice that the sum of the present values is now only $965.35, which is less than the face value of $1,000. This is why the bond will be sold at a discount to reflect the lower cash flows relative to the market rate. Let's look at the journal entry specifically for when the bond is issued at a discount. We debit cash for $965.35, reflecting the actual proceeds received from selling the bond at a discount. On the other hand, we credit bonds payable for the full face of $1,000. This represents the company's ultimate obligation to bondholders. The difference between these two amounts is $34.65. This is debited to discount on bonds payable. This account reflects the discount we provide to investors in exchange for a lower coupon rate compared to the market rate. Let's focus on the discount on bonds payable account. This is a contra liability account, which means it reduces the total liability amount presented on the balance sheet. In essence, the bonds payable account reflects the face value of the bond, which is $1,000 in our example, while the discount on bonds payable account represents the difference between the face value and the issuance price, which is $34.65. Subtracting this discount gives us the actual cash proceeds received, which is $965.35. We've seen how a bond issued at a discount results in a lower amount of cash received compared to the bond's face value. But how do we account for this difference over the bond's life? This is where amortization comes in. Now let's explore why we need to use amortization methods like straight line or effective interest The core principle is matching. The matching principle states that expenses should be recognized in the same period as the related revenue is earned. In this case, the discount represents an upfront cost of borrowing associated with the lower coupon rate. By amortizing this discount, we gradually spread this cost over the life of the bond, matching it with the interest income received by the bondholder. There's another important reason. Our balance sheet should accurately depict the company's liabilities. The discount initially reduces the bonds payable account, but through amortization, we gradually increase this account towards the face value, reflecting the true obligation as we approach maturity. We've established the importance of amortizing the discount on a bond issued at discount. Now, let's see how the straight line method works in practice using the example from the previous slides. This table shows the breakdown for each of the 4 semi-annual periods over the bond's life. The interest paid column represents the fixed cash coupon payment of $50 made every 6 months to the bondholders. The amortization column, this shows the portion of the discount recognized as expense in each period using the straight line method. We calculated the discount as $34.65, which is $1,000 face value minus $965.35, which is the issue price. With 4 payment periods, the amortization per period is $8.66, which is $34.65 divided by 4 periods. Next is interest expense. This crucial column shows the total interest expense recognized in each period. We add the interest paid, which is the coupon payment, to the amortization amount. Here, the interest expense for each period is $58.66, which is $50 interest paid plus $8.66, which is the amortization. And the last column shows the book value of the bond. This column tracks the bond liability on the balance sheet over time. It starts at the issuance price of $965.35 and increases by the amortization amount each period. Here we can see that 965.35 plus 8.66 gives 974.01, which is the book value of the debt at the end of period 1. And then you add a further 8.66 to get the book value of debt at the end of period 2, and so on. At the end of 4 periods, you should end up with $1,000. With the straight line method, the amortization gradually reduces the discount while the book value of the bond increases. Over the 4 periods, the entire discount is amortized and the book value reaches $1,000, which is the face value upon maturity. Straight line provides a straightforward way to distribute the discount expense. Later, we'll examine the effective interest method, a more complex but precise approach that considers the time value of money. Okay, we've explored how the straight line method allocates the discount on a bond issued at discount. Now, let's look at the corresponding journal entries. Recall that we've already seen the entry at the time of issuance where we record the cash received, the bond payable liability, and the initial discount. For each semi-annual period, we recognize the interest expense. We debit interest expense for $58.66, which includes the $50 coupon payment and the $8.66 of discount amortization. Simultaneously, we decrease the discount by crediting the discount on bonds payable account by $8.66, and we credit cash for the $50 coupon payment. Upon maturity, first we remove the bond liability by debiting bonds payable for its face value of $1,000, and then we credit cash for the $1,000 paid to the bondholder, representing the principal repayment. Let's quickly look at an alternative way to account for a bond issued at a discount without using a separate discount on bonds payable account. At issuance, we directly record the bonds payable at the amount of cash received, which is lower than the face value in a discount scenario. In our example, we debit cash for $965.35 and we credit bonds payable account for the same amount. With each semi-annual period, we recognize the interest expense using the straight line amortization method. As before, we debit interest expense for $58.66, whereas instead of crediting a discount on bonds payable account, we now credit bonds payable directly for the amortization amount of $8.66. This gradually increases the bonds payable balance on our balance sheet. At maturity, the final entry includes a debit to bonds payable for the remaining amount of the discount, which is $34.65, and another debit to bonds payable for the full face value, which is $965.35. So together, a total of $1,000 in debits. We credit cash for the $1,000 paid, representing the principal repayment. This method achieves the same goal of recognizing both the bond's interest and the discount amortization. Instead of a contra liability account, it directly adjusts the bond payable liability on the balance sheet. So far, we've explored the straight line method for amortizing the discount on a bond issued at discount. Now, let's introduce the effective interest method, which is a more precise approach. Straight line allocates the discount equally over a bond's life, regardless of the interest rate or the changing book value of the bond. The effective interest method considers the time value of money and calculates the interest expense based on the bond's carrying value or book value at the beginning of each period. This results in an increasing amortization amount over time as the book value of the bond increases. This table shows the breakdown for each semi-annual period using the effective interest rate method on our discount bond example. The interest paid column, as earlier, represents the fixed cash coupon payment made every 6 months. The interest expense column shows the total interest expense recognized in each period using the effective interest rate. It is calculated as 12% times half, in order to represent half a year, times the book value at the beginning of each period. The amortization column will reflect the portion of the discount recognized as expense in each period. This can be calculated by subtracting the interest paid from the interest expense in each time period. And finally, book value of bond. This column will track the changing book value of the bond throughout its life. It starts at the issuance price and will be updated each period based on the interest expense and amortization. In this case, we can see that the book value of debt is increasing by the amortization, which is calculated in this column. And finally, at the end of 4 periods, we are left with a book value of $1,000. Unlike the straight line method with fixed amortization, the effective interest method provides a more dynamic calculation that reflects the changing value of the bond over time. It's important to note that the structure of the journal entries remains similar to the straight line method. We will record interest expense, amortization of the discount, and the cash coupon payment. However, the key difference is that the amounts for interest expense and discount amortization will vary in each period under the effective interest method because the amortization is not constant. The specific amounts can be obtained from the table as calculated. Additionally, remember that the alternative way of recording these transactions still exists. We can always avoid using a separate discount on bonds payable account and instead directly adjust the bonds payable liability on the balance sheet. Now, let's switch gears and explore what happens when a bond is issued at a premium. This occurs when the bond's coupon rate is higher than the prevailing market rate. For our example, the bond has a 10% coupon rate paid semi-annually, but the market expects an 8% return for similar investments. This makes our bond attractive to investors. Visualizing the cash flows, we see the regular $50 interest payments for 4 periods, followed by the $1,000 principal repayment at maturity. However, since this bond is attractive, the investors are willing to pay more than the face value upfront. Our next step is to calculate the actual issue price of this bond, which will definitely be higher than $1,000. Now let's calculate the price at which this premium bond will sell. Since the coupon rate is higher than the market rate, it will trade at a price above its face value. Recall that we calculate the present value of each cash flow using the market rate. Because interest payments are paid semi-annually, we'll again use 4%, which is half of 8%, as our discount rate. Notice that the sum of the present values is now $1036.30. This represents the bond's selling price at a premium. Now that we understand how to calculate the price of a bond issued at a premium, let's explore how we account for that premium over the bond's life. We'll use the straight line amortization method with some key differences from bonds issued at a discount. The concept of amortization remains the same. We gradually spread the premium amount over the life of the bond. We use the straight line method, meaning we will amortize equal portions of the premium in each period. With the discount, we amortize it to increase the bond's carrying value towards the face value. With the premium, we amortize it to decrease the bond's carrying value down to the face value by maturity. Let's look at the calculations in this table. Notice that the book value starts at the issuing price of $1036.3 and gradually decreases over time. Let's break down the calculations in this table. First, we determine the total premium by subtracting the face value $1,000 from the issuer price of $1036.3. This gives us a premium of $36.3. Next, we divide the total premium by the number of payment periods, which is 4, and find the amortization per period, which comes down to $9.08. In each period, the interest paid remains constant at $50. The interest expense is calculated by subtracting the amortization amount from the interest paid, resulting in $40.92. Notice the amortization amount is subtracted here since it reduces the premium on the bond. Finally, we adjust the book value of the bond each period. We start with the issue price and then subtract the amortization amount every time period. The book value gradually decreases until it reaches the face value of $1,000 upon maturity. Here are the journal entries for a bond issued at a premium using the straight line amortization method. Let's focus on the key differences from bonds issued at a discount. Similar to the discount scenario, we record the cash received and the bonds payable liability. However, unlike a discount where we have a separate contra liability account, for a premium, we have a premium on bonds payable account with a credit balance. This represents the excess amount paid over the face value. The interest expense is then calculated considering both the coupon payment and the amortization of the premium. However, unlike the discount scenario where amortization increased the expense, here amortization decreases the expense by debiting the premium on bonds payable account. Overall, the structure of the entries is very similar, but the key difference lies in how the premium on bonds payable account is used. It reflects the gradual reduction in the bond's carrying value to reach its face value upon maturity. Finally, remember, as we discussed when accounting for bonds issued at a discount, there's always an alternative method where instead of using a separate premium on bonds payable account, you can directly adjust the bonds payable liability on the balance sheet. Similar to the case of discounts, the effective interest method can also be used for a bond issued at a premium. It's a more precise approach compared to the straight line method. The straight line method allocates the premium equally over the life of the bond. In contrast, the effective interest method considers the time value of money and calculates interest expense based on the bond's carrying value, which changes each period. This calculation uses the bond's market interest rate at the time it was issued. Let's look at this table, which shows the breakdown for each semi-annual period using the effective interest method on our premium bond example. So the first interest expense, for example, is calculated by dividing 50 over 1 plus 4%, which is the interest rate for half a year, to the power of 1. So that gives you the present value of this $50 at the end of time period 1. Okay, and we repeat the process for all the time periods, just changing the power to the power of 2, to the power of 3, and to the power of 4. And amortization is calculated as the difference between the two. And once you've calculated amortization, you simply have to use it to subtract from the book value of debt consistently in order to reach 1,000 after 4 time periods. The effective interest method offers a more dynamic picture of how the premium affects the bond's value over time. The structure of the journal entries under the effective interest method for bonds issued at a premium is similar to the straight line method. We will record interest expense, amortization, and the cash payment in each period. However, the key difference lies in the calculated amounts for expense and amortization, which will change based on the effective interest rate and the book value. As in the straight line scenario, remember that you can opt to avoid using a separate premium on bonds payable account. Instead, just adjust the bonds payable liability on the balance sheet directly to reflect the amortization. Finally, this chart offers a helpful visual representation of how the book value of a bond changes over time under different conditions. It uses the straight line method, but let's explore what we are seeing here and how it helps us understand the big picture. Let's start with the bond issued at discount. Notice how the book value begins below the face value and gradually increases through amortization. As we approach maturity, the book value and the face value, they converge. Now consider a bond issued at par. In this case, the book value remains constant as the face value throughout the life of the bond. This stability occurs because there is no premium or discount to gradually adjust. Finally, observe the line representing a bond issued at a premium. The book value starts above the face value and through amortization steadily declines until it reaches the face value at maturity. Visualizing these trends using a chart like this helps put together the concepts of amortization, premiums, and discounts. It reinforces our understanding of how a bond's carrying value on the balance sheet evolves throughout its life. It's important to remember that if we were to use the effective interest method instead of the straight line method, the general trends would remain similar. However, the lines would exhibit slight curves due to the way effective interest method considers the time value of money. The rate at which the book value changes would slightly vary, reflecting the more precise calculation method. So far, we've explored traditional bonds that pay regular coupon interest payments. Now, let's introduce a unique type of bond, zero coupon bonds. What makes these bonds unusual? As the name suggests, they don't make periodic interest payments. This would make you wonder why anyone would invest in them. Recall our discussions on bond discounts. The key lies in the deeply discounted price at which these bonds are sold. Even without coupon payments, investors can still earn a return because the bond is purchased well below its face value. When a zero coupon bond matures, instead of receiving regular interest, the investor receives the full face value. The difference between the purchase price and the face value represents the investor's return. Let's understand how zero coupon bonds are priced. Remember, investors still aim to earn the market rate of return, which in our example is 10%. With no coupon payments, their entire return comes from the difference between the price they pay for the bond and its face value of $1,000. In essence, this difference acts as the interest. The key is calculating the present value. If an investor wants to earn a 10% return over 2 years, they need to determine how much should they pay today in order to receive $1,000 at maturity. We use a present value calculation here. For this bond, the present value or the price the investor should pay comes out to be $826.45. By purchasing this bond at $826.45 and receiving $1,000 upon maturity, the investor earns a return that's effectively equivalent to a 10% interest rate over a period of 2 years. Bonds are usually issued with long-term maturities. Investors who need cash before the bond reaches maturity always have the option to sell those bonds on the open market. Keep in mind that this type of transaction doesn't directly affect the financial records of the company that issued the bond. However, under certain circumstances, a company might decide to retire bonds before their scheduled maturity. One way to do this is with callable bonds. These bonds include a call feature giving the issuer the right to retire the debt early. Typically, callable bonds come with a call premium, a percentage of the par value added as compensation for the bondholders. Let's consider our example of a $1,000 bond issued at par with a 10% coupon rate and a 2-year maturity. If the company decides to call the bond at 102% of the par, they would then pay $1,020 to retire it. This $20 difference represents the call premium. When recording this transaction, we would debit the bonds payable account to remove the liability. Then we would debit a loss on the bond call account as this represents an expense for the company. This loss would also be reflected on the income statement. Finally, we credit the cash account for the total amount paid. Sometimes a company might choose to retire bonds without a call feature by purchasing them on the open market. This could be an attractive option if the market conditions cause the bond's price to fall below the price that would be paid with the call premium. Remember, interest rates and bond prices have an inverse relationship. If interest rates rise, the value of the existing bonds fall, potentially offering a cost-effective way to retire the debt early. This session explored the accounting treatment of bonds, focusing on how companies issue and record bonds at par, at a premium, and at a discount. We discussed the concepts of amortization, coupon payments, and how the book value of a bond evolves over time. We also delved into zero coupon bonds and how they are priced to deliver a return to investors despite the absence of periodic interest payments. Finally, we covered early retirement of debt and the accounting considerations for callable bonds and open market repurchases. In the next session, we'll shift our focus to equity, the other main source of financing for corporations. We'll explore how companies account for the issuance of common stock, stock dividends, and stock buybacks. Thank you for watching. See you in the next one.